All right, so Christian Brim here with Core Group. We have the Employee Financial Bootcamp. With us today is DaRenda Hanson, and I will let you know that we are recording this, so if you don't have anything that you want to keep private, don't say it, because it'll be out on the interwebs. So without further ado, I will turn it over to DaRenda. DaRenda, you want to introduce yourself, and the floor is yours.
Sure. I am DaRenda Hanson. I'm a relationship manager with Core, and I also am a financial coach. I have my own business on the side, but Christian asked me to present this today, so I'm kind of mixing the best of both worlds, I guess. So I'm going to start today. I'm going to share my screen if I can. Oops. There. Can you see the PowerPoint?
We can.
Why does this pop up? Okay, so what I'm going to talk about today is the first thing people think about when they hear that I'm a financial coach is, they say, oh, you manage people's investments. And the second thing I hear is that, oh, you help people with their budgets. Well, only half of one of those is true. I do not manage people's investments. I'm not licensed to. And I do help people with their budgets, but that's only like half the equation. What I do is I help individuals and couples with their day-to-day money habits to help them reach their short-term and long-term financial goals. So a budget is just one tool that we use to help them get to those financial goals. So if you
That's
Google,
a good-looking picture of the two of us, by the way.
Right. If the first thing people do when they're trying to get on a budget usually is go Google like personal budget spreadsheet or something like that. And if you go out on Google, you'll find millions upon millions of spreadsheets that you could use. And the one on the screen is an example of what will usually come up. So it takes your monthly income, your monthly expenses, and gives you the difference. So this should be the amount of money you have left at the end of the month. In reality, that doesn't usually work because A, most of us don't get paid once a month, and B, our expenses don't come out once a month. So the reason that most people fail at their budgets is for this reason and some other reasons, because most of the people I talk to come to me and say, oh yeah, I've tried to budget, but it just didn't work out for me for one reason or another. And once we start deep diving, I find out that the reason those budgets failed are usually for one of these reasons. The first two kind of go together. It could have been too restrictive or it wasn't realistic. Most people, when they go on a budget, they just start cutting out all the fun stuff, all the things they enjoy. They think they have to get it down to the bare minimum. And that's not a realistic budget for most people because it's like a diet. Once you restrict yourself for so long, you're just going to fall off the wagon. And most people don't get back on. It's usually not done, or it's usually done monthly rather than by payday. Like the example I showed you, it is a monthly budget, so it takes your monthly income, your monthly expenses, and gives you a bottom line. And that doesn't work for most people. Next is that whammies happen. So emergencies happen. It's going to come up. You're going to have a car repair. You're going to have a home repair. You're going to have to take your kid to the dentist or the doctor or something. So whammies always happen. And most of the time, people that are on a strict budget haven't calculated for those whammies or haven't saved for those whammies. The next one is that their values are missing. So this kind of goes back up to the not realistic part. One thing I have clients do when they first come on is go through their values. What are their values? What's important to them? And we write those in the budget, assuming they're realistic. So if those values are being met, then their budget is more realistic for them and easier to obtain.
DaRenda, could you give me an example of what a value would be? What are you talking about there?
It could be traveling. It could be a woman going to get her hair done every month or her nails done. It could be like a guy going on fishing trips. It's whatever it is that makes them tick. For a married couple, there could be 6 different values because I have each person list their top 3. So if both of their values are being met, they're more likely to work on it as a team and not fall off the wagon, per se.
Got it. Okay.
And lastly is poor implementation. So you just have this monthly spreadsheet. You see that you're supposed to stick to these numbers you've put in, and it just, for whatever reason, it falls apart. You can't stick to the budget you've given yourself for the grocery store, or, I mean, there's a million different reasons it doesn't work. So I try to teach clients a better way to budget. And this is what my spreadsheet looks like. It's an example. Say you get paid every 2 weeks. You get paid on July 1st, and then you're going to get paid again on the 20th. You have a beginning balance of $165 in your checking account. You get a paycheck of $1,600, and you're going to take out the expenses that are going to happen before your next pay period. So this says you should have $982 left at the end of this period. So it's up to you what you do with this money. If you're working on paying off a credit card, if you're working on saving for retirement, or maybe going on a trip, you can write it in here and it'll calculate, it'll take it out of here, but this also transfers over to the next period. So it's a rolling budget, and you can see how if you pay a credit card off this month, how it's going to affect your budget next month. This really helps clients like see long-term how their actions now are affecting their future. This is also true when people use budgeting apps, because those apps usually only let you budget the money that you have now. So if you have $500 in your account now, what are you going to do with that $500? Which is fine and dandy, but next month you might be $200 short. You have another expense coming up that needs to be in there that it's not looking at, and you might come up short next month if you pay $500 to your credit card this month. So this way of budgeting.
I may be jumping ahead, but so how do you handle things that you pay less frequently than a month? So you have down here car repairs, or tax filing. So something you only pay once a year, right, or maybe saving up for a trip at the end of the year. So how do you handle those things? Right.
So I set up sinking fund accounts, so it can be in separate accounts. Like Capital One has an online banking system, and you can basically set up all these different savings accounts. Some clients like to use this, some don't, but you can set up different savings accounts for different line items. So like in this example, they're saving $200 a month for car repairs and registration, which they only pay every so often when it comes around. They're saving up for gifts, which could be Christmas, it could be birthday. They're saving up for a clothing allowance. So if they're only saving up $100 a month, when they go to the store to go clothes shopping, they have $300 in their clothing budget account. That's the most they can spend. So it's another way of keeping them on budget, but at the same time, saving a little bit monthly for these things. And then vacation and travel is the same way. You might, spice up these accounts a little bit if you know that you're saving for a certain vacation or something. If you have a big car repair coming up, you could up a little bit. And it's not like a 100%. I mean, there's times when you're going to have $300 in your car repair fund, but your car repair fund was $500. But it lessens the amount of the whammy that you have to absorb in the month you're in by having that $300 already in your account. So I wasn't going to go.
And so let me. Well, I'm sorry, I'm screwing everything up.
No, that's okay.
Let me ask another question. So when you're talking about actually tracking these things, so groceries would be a good one, or eating out. Things that aren't like line item expenses on your bank account. So your rent, you got in there, that's a check or an auto debit, and it's one transaction. But your groceries, you may go to Sam's Club or Costco, and you may go to Winco. So how do you track those things?
So I have some that like to still use cash. And I know some people it works really good for them and some people it doesn't. For some of them, it hurts them to spend the cash because they just see it leaving their hands and it literally pains them to see it go, so it works for them. Others have cash in their hand and they're more likely to spend it than they are if they had to swipe their card. Everyone is different. And so you kind of have to fill the client out and figure out which way is going to work for them, because there's no right or wrong way to do it. It's just whatever works best for you. And so if they're using cash, it's easy because they have $200 in cash. That's all they have. Once they spend it, they spend it. For a lot of them, they have to break the habit of using the credit card when they're out of cash, or swiping the debit card because they know there's money in there. And this is also where the budgeting apps can come in handy, because you can literally put in, or it can pull it straight from your checking account, how much you've spent at the grocery store, so you know how much you spent and how much you had available. Or you could do the old-fashioned way, which is what I prefer to do. I just use an Excel spreadsheet, categorize everything, and by putting it in manually, transaction by transaction, it makes me more aware of what I'm spending. So we don't necessarily use cash in our house. We do use some, but we go in and actually put the transactions in because it makes us aware of where we're spending, what we're doing, and what's going on. So there's no right or wrong way to do it. It's just what works best for you. Is that it?
Yes, I promise not to interrupt.
You're fine. So how do you get started on writing a budget this way? To begin, you need to write down all your expenses, your monthly recurring bills by due date, because you're going to need to know when they're due, so you can, at a glance, see what bills are due between now and your next pay period. You'll need to include in that food, gas, and day-to-day expenses, and it will calculate, this spreadsheet calculates your surplus or deficit for you. A lot of times clients have to go through like the last 2 months worth of bank statements, and this is a lot of back work, but it's necessary. And then a lot of times it's eye-opening to go back and figure out how much they spent on food and gas and day-to-day expenses in the last 2 months. How much eating out have they done? How much groceries have they bought? How much gas have they bought? How many times have they stopped at the convenience store? And that is eye-opening for a lot of clients because they just swipe that card and don't realize how much they've actually spent. But it'll give them a good idea of how much they need to include in their budget. And then it'll also give them a good idea if that's an account they need to look at budgeting better for. So once we get to this point, this is where we break down their, we're going to go through this like on their bank statement, and they're going to classify all of their expenses or all of their transactions into 3 categories: needs, wants, and obligations. So their needs are the basic things they have to live: their shelter, food, their transportation, their clothing, for some of it's medication. Their wants, which is their cell phones, their entertainment, their eating out, the things that they want. And a lot of times people want these wants to be needs, but they're not. And then the third one is obligations. So what are you in a contract for? A lot of times it's a house or a car, child support, anything that you have a bank note for that's due every month, it's coming. So they go through their bank account or credit card and categorize all these expenses. And depending on if they have a surplus or a deficit, we're going to start going through these and seeing if it was a deficit, obviously. We're going to go through and see what we can start considering for elimination. So you're going to start with the wants category, obviously, and go through and see what is an expense you could lessen. Is it you're spending a lot at the grocery store, but you're also eating out, so you're throwing away a lot of groceries because of spoilage? Is it that you're stopping in the convenience store too much, or maybe it's Starbucks or whatever? Really, really consider what of these wants you are willing to cut back on. The second category we would look at is obligations. A lot of these are your debt on your house or your car or your credit cards, things like that. But consider calling the creditors, especially if your credit cards, and asking for a lower interest rate. Even if it's temporary, a lot of the times they'll give you a lower interest rate, and that'll give you time to at least maybe get ahead on it, save a little money. Sometimes you can settle a debt for less, but you have to watch out for cancellations that will affect you at tax time. And oftentimes you can even renegotiate your payments or move the payment dates around so it hits you at a better time of the month for your pay period. Like if you have a big payment that hits at the same time as your house payment, it would be easier for you to split those two up to 2 different pay periods. A lot of times moving payment dates around is no big deal for creditors. So it's better.
How often do you when you're going through this, do you say, well, you know what, we're looking at your obligations. We've gone through your wants, your obligations, and you need to get rid of the Mercedes lease and go get a Subaru, or your house, you really can't afford this much house. How often does that come into play?
Yeah, so that it comes up fairly often, and that is when we have like a tough love conversation with a client. Obviously that's our needs category, and they're probably could be using the house or the car more of a status symbol, like they don't need a Mercedes or whatever in their situation. It's really dragging them down. So a lot of times you can kind of take what they're paying for a monthly payment and break it out and be like, if you weren't paying $800 a month for this car, you could pay off this credit card in, a few months and put yourself in a lot better position. Those conversations are hard to have, and they do happen, but a lot of the time you just have to figure out the client and what's going to speak to them. If they're really wanting to pay down the debt, it may be comparing how quickly they could pay down a debt if they got a cheaper car. Or if, there are the ones where they need to maybe look at a different house or sell the house they're in and rent for a while. And for some people, it's letting them know it's not permanent. It's just temporary until we can get you in a better place.
So let me ask you a question, since we're on the subject of debt. My favorite, Dave Ramsey. So, Dave Ramsey's big on no debt, and the debt snowball, that's one of their marquee things. So do you recommend to people that they follow that path, that they have no debt?
So Dave Ramsey loses me after like baby step 3. He's obviously how I got started, how my husband and I went through our journey. But so all debt is not bad debt. Right now, we're in the middle of refinancing our house to a 2.75% interest rate. So if I looked at paying that off early, like throwing a little extra at it every month, it doesn't make sense if I can make more, for me, in my opinion, if I can make more than that throwing my money into investments somewhere. Because my house is still going to be paid off in 20 years no matter what. It also depends on where they're at, how their retirement looks. I mean, really what their overall goals are. Because some people come and their goal isn't to be debt-free. Their goal is to be able to travel, 4 or 5 times a year to really nice vacations. So it just depends. I can't throw my views on the client. It depends on what the client's goals are. Even though my goal would to be debt-free, that may not be their goal. So, but I don't necessarily agree with being debt-free, but I don't necessarily believe in paying all your interest to a bank either. So there's that. So next we're going to look at net worth, and then we're going to look at credit scores and why you need to be paying attention to both. Net worth is your total assets minus your liabilities. So for an accountant, I know what that is, right? But for the layman, that is the things you own minus the things you owe. So an asset could be your house, your retirement account, a health savings account, your cash, your savings, any equipment you own, real estate. There's a lot of things that could be an asset. This is just some examples. And your liabilities are what you owe to other people. So your mortgage, your credit card debt, your home equity loans, any personal loans, anything you owe to another person. So, oops. Why is net worth important? I like to go through net worth with a client when they first come on. As painful as it can be sometimes, sometimes it's better than they expected, and sometimes it's not as bad as they anticipated. But it gives them a really good starting point of where they're at. So if they have quite a few assets, but they have the liabilities to go with it, then their net worth isn't that great. But if their goal is to pay off that debt, then later on down the road, in 6 months or a year, they can do their net worth calculation again and see how far they've come. So it's kind of a check your temperature. If they've really been putting their head down and paying off debts or throwing money at retirement, they can kind of lose sight of the big picture and all that because they don't really see the fruits of their labor yet. Calculating their net worth gives them a really good temperature check of how they're doing, and sometimes it can be what keeps them on track. So I think calculating your net worth is a really, really good way to help some people stay on track and know what's going on. And last, we're going to talk about credit scores. So some people only worry about their credit scores when they're going to borrow money. And that's when they find out that there could be incorrect information or fraudulent activity on their credit reports. Credit scores are important not only when you're borrowing money, but also they affect your interest rate, your insurance rates. Sometimes they can affect your employment opportunities, and not to mention it affects your interest rates when you are going to borrow money. It's important to keep tabs on your credit score and know what's going on. And there's 2 services that I recommend for this. They are Credit Karma and freecreditreport.com. So Credit Karma monitors the Equifax, TransUnion, and Experian, the 3 major credit bureaus. Their credit scores on there are not 100% accurate. They're kind of just, I don't know, I wouldn't even say average. They're okay. They're not accurate, but you can set it up to email you with alerts. So they can send you an email alert when there's a new inquiry on your credit, when new cards are open, when there's late payments, when something's gone delinquent, when a credit card's been paid off. Like, it can send you some really good information. And it's like up to minute. Like I said, we're refinancing our house. I got an email like the second that the mortgage lender dinged my account to check my credit. And I was like, oh, okay. So it made me feel safe. But it's just a really good way to keep track of what's going on. And the reason this is important is you need to be proactive in catching any identity theft. It allows you to take quick action if there is fraudulent activity, so you know about it before you've gone to get a loan from the bank. And you can also keep an eye on your credit score as you're paying down debt. And just like your net worth, it's a good thermometer of how far you've come if that's your goal, is to pay down that debt. You can see that credit score going up as you're doing it, and you can see the fruits of your labor. And also when Credit Karma pulls your credit, it's a soft pull, so it doesn't affect your credit score at all. And the last one is freecreditreport.com. So they allow you to get 1 free credit report per year. It'll give you an accurate score, but my argument with this is that 1 per year isn't vigilant enough to keep track of your credit. Because of the reasons I stated for using Credit Karma is the reason I think you need to keep track of it more often than that. So, any questions?
I don't have any questions from the crew, and I don't really have any questions. I have a comment about, you know, the whole cash envelope system and how simple that is, but it requires the behavior change. And so, you know, we work with clients in implementing Profit First, which has some very similar principles of, you know, setting priorities and only spending what you have. But what I have found is that in those situations where people don't aren't successful like they expect is it's because they haven't changed their behaviors. You know, you can have all the spreadsheets in the world and all the bank accounts, savings accounts set up and you know, tracking, but if you don't change your behavior, you're not going to get a different result.
Right.
So same thing, business and personal. And you know, I think a lot of business owners could benefit from this same thing, because the personal finances, how you handle your personal finances, usually is how you start or continue handling your business finances, because that's what the habits you've learned, right? Because it's all about habits.
Yep. Yeah, it carries over. You wouldn't be surprised, but a lot of people would be surprised of how business owners whose finances are out of shape, their personal finances are also out of shape.
Oh yeah, yeah.
And
yes,
behavior is totally 99.5% of it.
Yeah, and I think, you know, like you said, when people get they fall off the wagon or something happens, and that's when they stop. But that's where the process or the structure, or the system that you're using can help you stay on target, so that you don't just give up, throw your hands up and say, this isn't working.
Right, and I think that too, well, I know that too, that's where a financial coach is helpful, because we are there when they try to fall off the wagon, and we bring something back into play. No, look, this is what you've done. This is how far you've come. You've done a great job. You know, we're that accountability partner when something starts wavering in their thinking process. I like to compare it to a personal trainer when you're trying to lose weight
right.
or get in shape. I'm just a personal trainer for your finances.
Nice. DaRenda, appreciate your time. Good stuff. And as my friend Corey Miller says, we will wave until the camera is off. Bye-bye.